we're looking at trade receivables. We looked at trade receivables collection period. Today we'll be looking at trade payables period, looking at the outflow of funds. Receivables is the inflow of funds, current assets, while trade payables, the outflow of funds. We are trying to pay our obligations in simple form. Okay. So it's also known as days payable outstanding, just like the receivables is known as days sales outstanding, which measures the average number of days a company takes to pay its suppliers for goods and services received on credit. Take note, on credit. So the same way companies sell on credit is also the same way they buy on credit. Most of the credit terms are stated in the agreement or in the SLAs, the service level agreements, or the contracts signed by both companies. Typically, most of the time, there's a 30-day period or time frame to pay up after receipt of goods or services, typically in general terms. So take note of it. They are payments on credit, not cash. Also, companies buy in cash, same way they sell in cash, and also they buy in cash sometimes, and they also buy on credit to take advantage of credit terms, discounts, and so many other rebates that comes with trades and purchases. Okay. So this ratio or metric is crucial for understanding a company's cash flow management and its relationship with suppliers. This is very important. So this ratio helps us look at how long in number of days we pay suppliers, and we're able to manage our relationship as a company with them. Cash flow management is important in the cycle of, or the cash operating cycle that has to do with receivables, trade payables, and inventory. Take note of that. So the formula is clear on the screen. We have it as trade payables times divided by credit purchases. And where you don't have credit purchases in the question or in the financial statement, you use your cost of goods sold. It's an alternative. We have it as trade payables divided by credit purchases or cost of goods sold, times 365 days. What does it mean? It indicates how long a company takes on average to pay its suppliers. We measure it in days. That's simply what it means. So a longer payables period can suggest that the company is effectively managing its cash flow by delaying payments. So the longer the better for the company, because it will use its cash for other things. It could even invest it in short-term marketable securities to get some income before paying off. A shorter period may indicate the company is paying promptly, which is good, but a longer period is better because it helps you channel your resources to very more important pressing needs. And the implication is that a longer trade payables period is generally favorable, as it allows the company to retain cash for a longer time, and this enhances liquidity. Take note of that. Okay, so before we go further, let's look at the same example we have been looking at. I said Sharubutu, Dan Kabir. Let's use Dan Kabir to calculate this ratio very graphically and see how it applies graphically. Okay, so the formula we are using is trade payables, but then the trade payables has to be an average. You can see there's average, there's an average. Same way with the receivables. So we have to do an average. We have the 3-year financial statement. So the beginning and the ending, I will divide it by 2 to get the average. So let's practicalize this formula and see how many days it takes for Dan Kabir to pay off his creditors. Okay, so on our financial statement, we have trade payables beginning as 157,500, and we have the closing. If you can see from the SFP, we have January and we have December. So we have, for trade payables, we have 157,500 million, 157,500,000, and we have 189 million. So let's take the trade payables for the beginning and the ending. So let's take the trade payables for the beginning and ending and use our calculator. If you have your calculator and your notebook, let's follow through. So this opening, and we have the closing. Okay, that's fine. So we have our average trade payables. As
73, 250.
Okay. Oh, fine. That's nice. Thank you. Exactly. 173, 250. Thank you for that. Okay, so let's go back and pick our, according to the formula, what does this state? So we go for credit purchases. Yes, cost of goods or credit purchases. So make sure you read the financial statements very, very fully. Take notes of the notes. One good thing about financial statements, or one thing you need to take note about financial statements, is make sure you read the notes. The notes has in the hidden information if it's provided in the financial statement. So take note here, you'll see on note 2 of the total purchases yearly, 80% was made in cash. Take note. Of the total purchases yearly, 80% was made in cash, while 20% was made in credit, on credit. So take note on that SCI, we have purchases. Don't forget, some financial statements don't provide purchases. So we have purchases for 31st December, which is 1.1 million. So take note of it. And that note or the caveat says 80% was in cash. Take note. So note 2 says of the total purchases yearly, 80% was in cash and 20% on credit. So if you go back here now on the SCI, you will see that there is a detailed information provided on opening inventory, purchases, total. So some will just say revenue, cost of sales, gross profit. They don't provide this full information on the manufacturing cycle. So here is provided, and take note of it under exam condition. So we've taken that purchases, and let's get 20% of our credit like it states. So purchases.
It's 220.
Okay, so this is 100%. So cash. Cash purchases is 80%. Yes, let's put it graphically. And credit is
so it's 20%. It's not 20 you look for.
Exactly. So I'm just putting it there so that we can have the solution very, very clearly. So credit.
That's 220.
Okay, that's 220. Fine. Fantastic. So 220. Let me do it with my this divided by 0. No, times 0.80. We have 880, and we have this times 0.20. I think that's the 220 you're saying exactly. So we now have our trade payables period, or our days payable outstanding. We have it as our average trade receivables divided by a credit purchases, not cash, times 365 days. And we have it as 287 days. So it's not up to 50. So just say, wow, that's long. 287 days. That's really long for trade payables. So can we convert the days to months and years? So we have 365 days in a year. So how many days is 278 days? We have 278 days.
287. What are you looking for?
I'm looking for how many months, how many years. I know it's not up to a year, So how many months does it take them on average? 287 days is how many months?
287 divided by 30.
Yes, divided by 30. Exactly.
That's 10 months, 9.5. That's 10 months, 9 months.
Okay, 9 months.
9.5.
Okay, so let's say 10 months approximately.
Mm.
And that's actually long to pay off your debts. It's actually long. So a lot of yeah, exactly. A lot of dissatisfaction and clients complain. Creditors complain. Creditors are not comfortable with 10 months. It's actually long. Though their receivables collection period, you can see, is even longer. How many years did we calculate for receivables? Calculated 842 days. So 365 times 2, that's about 7 something. So it takes them about 2 years or so, 2 years plus from our computation in the last class to get their receivables. But then looking at also the amount involved, it may not be that material, but 220 million is actually material. If cash purchases were about 80 million, 80%, 20% is also material. So they need to improve on creditor relationships and also making payments on time. Normally, the general approved or time frame to pay off your creditors is 30 days. So the 30 days, 1 month. I mean, you're going 10 months. It shows they are not doing well, really. No matter the reason is, they are not doing well. There needs to be improvement in their trade payables. Okay, so having looked at the first month, how can we look at namesake and Julie? Can you calculate for 2021, 2022?
299.3 days.
Okay, in fact, let me just say 300 days.
Yes, no, 299 days though, because it's 0.3.
Okay, 299, exactly. It's not up to 5. All right. Wow, that was fast. Okay, namesake, do you have 2022 or do you agree with 2021 too?
2022 is 292.5 days.
Okay, so let me say 293 days. Wow, that was fast. Thank you so much. That was really fast. Do you have a differing opinion, namesake?
Oh, not at all. Not at all. I'm following, sir.
Okay. Okay. All right, so let's validate Julie's figures. Thank you, Julie. That was so fast. So let me pick the trade payables for this month and take the average. Wow, you're really fast in calculating the average. Okay, so we have, so this will come as the second, and this will come as the first. This also will come as the second closing, and this will come as the opening. Okay, so let me just drag with Excel. Let me go pick purchases also. Purchases is 1.2 and 1.3. Okay, so I have purchases. Let me just, since I have the formula, let me drag 80% here. Let me drag my 20% also here, so I have it. So I'll just drag. This is the beauty of Excel. Exactly. Julie is very, very correct. But your approximation here, 292 days, even though insignificant.
I said 292.46.
Oh, okay, 292.46. That's what you said. All right. So it's 292. It's not up to 5.
Yeah, 292, yes.
Okay, fantastic. This is correct. So how many months is this now? Can you get me the months? 292 divided by 30. 299
divided by 30. That's 9.9. That's 10 months.
Okay, 10 months and 10 months.
10 months too.
Yes, 10 months too. Okay, fantastic. All right. That was fast. And I appreciate that. Shows we are really following. Okay, so we've looked at the meaning. Then let's look at the implication. Now, the longer the better. Why? Because you are tying down money to use for other things, but then you have to balance it. You can't scuttle somebody's business and his cash flow to enhance yours. Though generally in business it's allowed, but then there has to be balance. Even if you are enhancing your liquidity, you also have to consider the other creditors' liquidity also. It's very important that balance is so excessively long periods may strain supplier relationship. Like we opined here, I think 10 months is too much, sincerely. 10 months is too much. No matter the agreement.
Yes.
Yeah, no matter the agreement. I think 10 months is too much. And I don't think any agreement will go beyond 3 months or 2 months. 10 months is a strain on their cash flow. And this strain or relationship may lead to potential penalties, especially where the terms and conditions apply. If you don't meet those conditions, there may be penalties, interest, and also fines for not paying on time. So these are the implications one needs to avoid and ensure the parties meeting up with their own terms of agreement. So let's look at the shorter period, which indicates strong relationship with suppliers and a focus on maintaining good credit terms. So it's good that a shorter period, 1 month, 45 days, 2 months at most, will enhance relationship with suppliers and also focus on maintaining good credit terms. That's the converse, the converse area on looking at the higher and the shorter period. And the effect is clear. If you don't pay on time, which is a longer trade receivables period, like we saw in Dan Kabiri's case, it's the longer one shows, well, you are effectively managing cash flow, you are strongly negotiating, you have strong negotiating power with suppliers, and you have delayed payment policy. If it's in a policy to delay as much as that is good, but then if it's not, it's risky. And the effects of a longer trade payables is increased liquidity, which is good, better cash flow management, but potential risk of damaging supplier relationship. Because if some suppliers that provide raw materials refuse to provide, that means your production has been cut short. If payments are excessively delayed, they will not provide for your next production cycle. So those are one of the effects. So what causes a shorter trade payable period? Good supplier relationship is the cause. Early payment discount, you take advantage of payment discounts. There are some terms they will tell you if you pay before 30 days, you get 10%. If you take advantage of that, you've also gotten some other income to reduce the cost, which is good. Or a focus on maintaining strong credit rating. So if strong credit rating is the goal, then you must maintain it by paying on time. Very important. And the effects of a shorter period is improved supplier relationships. Yeah. The relationship is very important to foster your continuous production and service processes. Potential cost savings from early payment discounts, but it may strain cash flow if payments are made too early. So that's why I said balance is key. Don't pay too early and don't pay too late. Make sure you are maintaining liquidity, and that's the job of chartered accountants. You're working, you're ensuring that the working capital management is managed based on your needs on ground. And you're facilitating it, and it's a skill that comes with practice and everyday experience. Very important. So in conclusion, the trade payables period is a key indicator of management's cash flow of the company's cash flow management and supplier relationship dynamics. So two key components in this metric is looking at cash flow, ensure you don't have cash flow challenges, and also supplier relationship challenges. If you're able to manage these two, then you're a good chartered accountant, a very good chartered accountant. So you need to monitor this ratio for businesses so that you can balance the benefits between retaining cash for operations and your needs, and also maintaining healthy relationship. So you see those two issues when you are discussing this ratio: cash flow management and also your relationship with suppliers is key. It ultimately enhances financial stability and also operational efficiency. This is very, very important. Okay, so I'll take questions on this trade receivable because the examiner tends to ask more of these, mostly in his ratios. So any questions, any contributions, any observations on this ratio?
For me, nothing.
Okay. Namesake, you like it? You're okay with it too? Is my namesake on the call or he has left?
Oh, no.
Okay,
Sorry, I was doing that.
Okay.
Sorry.
All right. Oh, that's fine. Okay, so let's go to the next one. I like this one. It used to be my favorite in the university. My friend, when we were writing ICAN, we like this ratio very much. We always pray they test it. Operating cycle, also known as cash conversion cycle. But unfortunately, he hardly tests it. Even during our time when we were writing the exams, we didn't see it, but we like calculating it. It's very easy. Okay, so the operating cycle is also known as cash operating cycle. And take note, most textbooks you see, these three ratios from inventory, receivables, and trade payables are stated as activity ratio. Why I brought them here is because they are in days. So I brought them under liquidity so that there can be a separation. So we'll know the difference between those in days and those you calculate by looking at how many times. So when we move to activity and efficiency, we'll also see another ratio that talks about how many times, but it's just a reverse of this. So if you understand the reversal of the numerator and the denominator, you will not have issues. So I brought it to liquidity since it has more to do with working capital management. I brought it here. So you may also look at it as working capital management ratio or liquidity ratios, but most textbooks look at it as activity ratios. So they will talk about the ones in days and the ones in times. Even in the Pathfinder, sometimes he calls them activity ratios. But whatever synonym or name you give them, don't really matter. Just make sure you understand the dynamics, the application and the implication and the interpretation, which is very, very important. Okay, so the cash conversion cycle measures the time it takes for a company to convert its investments in inventory and receivables, and also paying off payables into cash flow from sales. So you get money from inventory, you get money from receivables. So the number of days you are able to recoup your money from those asset items, and you also to pay off your obligation in terms of short-term payments. So the number of days looking at the cycle is what this ratio is talking about. So you're converting your inventory and account receivables to cash, and you're also paying cash or paying amounts to your creditors. So that's what this cycle talks about. It measures or helps businesses understand the efficiency of the operations in managing cash flow and working capital. This is very important. So the essence is to see how you're managing your operations day to day. And it's a key skill. You can have long-term prospects, but you can scuttle it by your inability to manage your day-to-day operations. So a company has very good investments in long-term assets, is doing well, but day-to-day operations are always hampered by these liquidity issues. It shows the accountant, mostly who is in charge, is not doing well in working capital management. So this metric is crucial in measuring how efficient and effective a chartered accountant is in their operations, in managing cash flow, and also working capital. This is very important. So the operating cycle is the time it takes in days and in months, just like we've calculated in the receivables and the trade payables, the time it takes for the company to convert its investment in inventory, receivables, and payables back to cash. It considers the number of days the company ties down its cash invested in inventory, tie down its cash in receivables, and also the cash of those he ties down in payables before the cash is realized after collection of receivables, collection of inventory, and payment of payables. The operating cycle of a company that manufactures, so we're looking at manufacturing firm that sells goods, comprised of 4 phases as follows. So like we saw in Dan Kabir, we saw raw materials, that's the opening stock. We saw purchases, and we saw closing stock. So if you look at it, Dan Kabir is more of a manufacturing company into pharmaceuticals. So this opening inventory you're seeing here is more of the raw materials. We have purchases, then we have closing stock. So this is their production or manufacturing cycle. Production or manufacturing cycle. Take note of that. That culminates in their cost of sales. So take note of that. Okay, so going back to our conversation, the raw materials and purchases are goods that are produced and kept in inventory. Yeah. Goods are sold from inventory to generate sales. revenue, which may be both credit or in cash. We have seen that in the receivables collection period of the day sales outstanding. So there's receivables, there's sales in credit and sales in cash. Also, it extends credit to customers, which leads to accounts receivables. And also, accounts receivables are collected to generate cash. However, for a company that only buys goods to resell, the first phase above will not apply. The first phase talking about the opening stock or raw material, it will not apply. So if they buy goods as their inventory and they sell, they don't produce. And the operating cycle will only involve the last 3 phases that has to do with receivables, selling of inventory, and payables. The same thing applies to a company that only renders services to its customers. The last 3 phases will apply, but production will not apply because you don't produce services, you only offer services. Operating cycle is normally measured by number of days in each of the phases listed above. For example, the number of days fund is tied up in inventory is measured by the total fund invested in inventory and the average days of cost of goods sold. Usually, the fund tied up in inventory is represented by the cost, represented by the closing inventory shown. Exactly. So if you look at Dan Kabir, most of it will always look at closing inventory at the end of the year, which we calculate to have our inventory figure in our SFP. There's a direct relationship, even if there are variations, but the inventory always have some inverse movement between the beginning and the end. You'll see that the amounts are always close to the closing inventory in the SCI. So take note of that. Okay, so however, it is felt that the average fund invested in both the cost of inventory at the beginning and at the end of the financial year is more representative of funds tied up in inventory during the year. So this is the reason why the average is used or is much more advised under exam conditions. So you use the beginning and the ending as average. But if you pick the ending, is also good. You may not be penalized, but the best measure and the best way is to calculate the average fund invested in the beginning and the ending to have the average. You may not have the actual, but you have the average to see the amount of funds tied up during the year. So both methods of calculating the number of days funds are tied up in inventory are however acceptable. So if you use the end of the year, it's still fine, but best, please use the average. The average is a more clearer picture of the amount. So the average days cost of goods sold, where you don't have credit purchases, is the cost of goods sold on average daily in the year, which is measured by dividing the cost of sales by the number of days in the year. So the number of days in the year is normally 365 days like we saw, but we use typically. Therefore, the number of days of funds tied up in inventory is calculated as the average inventory beginning and the ending divided by either credit purchases or cost of sales or cost of goods sold, as you may call it. So the number of days is up. Then we have the other activity down. We'll be looking at that subsequently as we go to activity. So there are 2 ways. You have the number of days and you have the number of times. So the number of days is converted in this formula, and we looked at the static one for the number of days and we look at the static one for number of times. So in the same way, we can calculate the number of days funds are tied up between the time goods are sold on credit before they are turned to cash. Yes, it's easy to calculate. Also, you give out credit in form of accounts receivables in the SFP at the end of the year. If this is used, this is representative of receivables during the year. We've calculated that and we've looked at the average receivables and the time it took Dan Kabir to recoup his receivables, which was very, very long. Also, otherwise, the average account receivable at the beginning and the end of the year can be used. Yeah, so you can use the ending of the account receivables, but typically the average is better. So where you have a 1-year financial statement, you don't have an average. You have no choice than to just use the closing average accounts receivables. But where you have 3 years, 5 years, you can use the average by using the beginning, the first year and the second year and the third year, as the case may be. So these are the number of days of receivables. We have the accounts receivables divided by average days of sales on credit. So where you don't have sales on credit, you just use your revenue. We also have the average accounts receivables and sales on credit by 365 days. So you have for the days for the month, if it's 30 days, and you have for the full year. Normally we calculate for full years during exam condition. In my office, I do it quarterly. So I look at the first quarter, January to March, and I look at the second quarter, January to June, third quarter, January to September, and the full year, January to December. So there are key risk indicators we monitor to see how effectively we are managing our receivables. So it's very practical. It's a very practical ratio. Now, coming in with the accounts payable in the SFP at the end of the financial year is used. Also, the payables is the outflow, your payments in cash to your clients and those, or your suppliers, those you owe. This is very, very important. The payables are very important. We just looked at Dankabir's payables. The average accounts payables at the beginning of the year and the end can be used also. It's the average is the perfect picture, not just at the end of the year, that provides us the representative of the payables during the year. So the formula is also in the screen. We've calculated it. Average accounts payables divided by the purchases on credit, or where you don't have purchases on credit, you just use the cost of sales. If the company does not buy on credit, the cost of sales is a perfect picture of the denominator. Okay, so the formula for cash operating cycle is your inventory holding period plus your receivables collection period, and you minus your trade payables period, and it culminates in your cash operating cycle or cash conversion cycle. So IHP plus RCP minus TPP gives you your cash operating cycle. So it's very simple. We will just do it from here. We have all our variables. So for the 3 years, for inventory, we've calculated it. And that's why we like the ratio. It's not a foreign calculation. You just take the number of this, put it here. So we have for inventory holding period, let me take inventory holding period. Okay. So we'll take our receivables collection period. Receivables collection period. We also have our trade payables period. We have our cash conversion cycle, also known as cash operating cycle. Anyone you use is fine. So let's go get the trade payables period we just calculated. We have 287, 299, 292. Fantastic. Okay, so I've already put days. So we do IHP plus RCP minus TPP. So for 2020, what do I have? Julie, can you help me with that? Hello, Julie, are you there?
Yes, yeah.
Okay, so for 2020, how many days do we have? 115 plus 842 minus 287.
Okay, add it up. Okay.
Yes, not add, you add the 2 minus the 3.
Add it up and minus, yes.
Yes. So let me put it here. Add. We add.
That's 670.
670.
The first one. So it takes 670 days to convert
the cash, their inventory and receivables and payables to cash. Exactly.
Cash.
Yes. It's hard. So how many months is 670 divided by 30 days?
670 divided by 30.
Yes.
22 months.
No. Their cash conversion cycle is bad. It is bad. It's bad. So let me have for 2021 and 2022. Normally, your cash conversion cycle is not supposed to be more than 1 month, so that you can enhance your day. Yes, you should enhance your day. 689. Wow. So Aisha, you're welcome to the call. Nice to have you. So how many days is that? Or how many months?
670. Okay.
How many days?
The other one is 675.
Okay, 675. All right.
That's 23 months.
For 2021?
Yes, please.
Okay, 23 months. That's much.
And the other one is 22.5. That's 23.
Yes, 22 point. No, let's say 23 too. This is 5. Okay. 23 months. This is much. This is awful. This is awful. Though the percentage, they recoup the amounts in those 3 variables. Like if you look at the inventory, I don't know how many percent the inventory is, but the inventory, the amounts of receivable is 85 and trade payables is 80. But no matter the amounts, actually, their cash conversion cycle is bad. That's my conclusion. Yes, their cash conversion cycle is bad. Okay, so let's go to the interpretation. Do we understand the calculation? Namesake and Aisha, and see you guys on the call. Do we understand these calculations? Okay. Yes. Aisha, are you okay? Aisha on the call, or she has left?
She's muted.
Text. Yes, sir. Thank you.
Oh, okay. All right. You're welcome. Okay, so what does it mean? The cash operating cycle indicates the number of days it takes for the company to turn its inventory to cash, accounting for the time taken to collect receivables and the time allowed to pay suppliers. That's what it means. So a shorter cycle suggests efficient management of inventory receivables, resulting in quicker cash generation. So the speed at which you get cash to run your working capital, to run your day-to-day operations is key here. And the implication is that a shorter cash operating cycle is generally favorable, as it implies that the company can quickly convert its resources into cash, enhance liquidity, and reduce need for external financing. So where you have 22 days, 22 months, 23 months, I mean, that's over a year. It's hard to, that means most of the time you are looking at external financing, borrowings in the case of Dan Kabir to finance operations day to day, which is not generally favorable for the company. So it's very important that companies and accountants maintain shorter cycles to enhance cash flow. A longer cycle indicates inefficiencies exactly in managing inventory and receivables, like we just saw in the case scenario, and it could lead to cash flow problems. And these ratios are short-term ratios that enhances your day-to-day operations month to month. So the longer it is, the more challenging it will be to be able to manage cash flow, and it will generate problems for you as an accountant. So please take note of that. So what is the cause and effect? The cause of a short COC is efficient inventory management, exactly. Quick sales processes, converting sales to cash. Effective collection strategies where receivables are collected in the near term. And the effects is clear. Improved cash flow reduces reliance on external financing and increases operational efficiency. This is very, very important. And the effects will always show. While a longer one, the causes are excessive inventory levels, slow moving goods, delayed collections, and this is the picture of Unkabim, or lenient credit terms to customers. So maybe they look at the percentage is low, and maybe the materiality threshold they set is, so they just become complacent and not push to collect their money or pay people or convert their inventory to cash. So the level of push and drive is also a factor that could cause high COC. And the effects, the cash flow constraint is the effect, potential liquidity issues, increased cost associated with financing operations. Exactly, these are the effects, and it must be avoided at all costs. So the cash operating cycle is a critical metric for assessing a company's operational efficiency in converting investments to cash. So typically, IHP plus RCP minus TPP, inventory holding period plus your receivables collection period minus your trade payables period. Yes, culminates in your cash operating cycle. Very, very.
So can you say that again? Sorry to interrupt.
Okay, no problem. So the inventory holding period, let me go back to the calculation. So your inventory holding period, as you can see on the screen, you add it to your receivable collection period, the days, and also your trade payables period. So where under exam condition, they ask you to calculate cash operating cycle, and they didn't ask you to calculate inventory holding period, receivable collection period, and trade payables period, then the examiner wants you to do a lot of work, because you cannot get your cash operating cycle without calculating your inventory holding, receivables, and trade payables. So where he gives you, even though I've not seen it in his 21st, all the 21 editions of his Pathfinder, I've not seen this question asked. But in case it's asked, you have to be very fast in calculating your inventory holding period, receivable collection period, and your trade payables period. So in answering your question, Aisha, your inventory holding period, you add it, your receivables collection period, you add it, and you deduct your trade payables period to have the cash conversion cycle. So typically, like we opined with Julie, you're supposed to have 30 days typically. So 30 days is the standard to maintain, to operate this cycle effectively. I hope that answers your question.
More than enough. Thank you, sir. It's more
Fantastic.
like a recap.
Yeah, that's good. That's good to hear. Okay, so let's run before we go on break. We have like 12 minutes to go on break. So let's calculate this last ratio. This last one. It's called net working capital to sales ratio. It's actually unpopular, but then it's sometimes featured in some of the ratio calculations. I think I've seen it once or twice on the examiners, one of his editions of the past questions. So the net working capital to sales ratio, it's an unpopular ratio, but it also works in practice. So this is for cash operating cycle. This slide is supposed to be before this. All right, so by monitoring this cycle, businesses can identify areas for improving in inventory, receivables, and also trade payables. So this slide is supposed to come before this net working capital to sales. All right, it's fine. So let's look at net working capital to sales ratio very quickly. It measures the proportion of the company's working capital that is relative to total sales. So working capital is used to manage, or is used to drive sales. So what's the essence of your working capital? Is to get more money, is to get revenue. And that's what this ratio speaks to. It helps assess how effectively a company is using its working capital to support sales activities. So whatever you're doing using working capital is not to spend the money, or accountants use it to be spending petty cash or running day-to-day operation. The operations should help you drive for more sales. That's what this ratio is speaking to. So whatever you're doing in the office, your working capital should help the office operate with the aim to get sales, to support sales activities. And that's what this ratio looks at. The formula is on the screen, looking at your net working capital divided by sales. So what is your working capital? Your current assets minus your current liabilities divided by your sales times 100. That is what the ratio speaks to. So you want to see the percentage of your working capital you're using to drive sales. It shows the relationship between the company's liquid assets after meeting a short-term obligation to its needs for liquidity, which is measured by sales revenue. So the company's liquid assets in form of current assets, you are meeting your obligations in form of current liabilities, and that need is measured by the sales revenue. And it's calculated as your current assets minus current liabilities divided by sales revenue. So let's align net working capital to sales ratio and also to cash operating cycle. So it relates, they relate. So the addition of the number of days in inventory, number of days in receivables, the number of days of payables give the operating cycle we just saw in the last ratio. So the purpose of calculating this operating cycle is to determine the amount of working capital that will be needed to meet the company's short-term obligations, and is referred to as the adequacy. So how adequate is the company in managing its working capital? So the longer the operating cycle, the more current assets are needed. Exactly. So that's why we're advocating for a shorter operating cycle. Current assets are needed if it's longer relative to the current liabilities, because it takes longer time to convert inventory back to cash. This means that the longer the operating cycle, the more the net working capital will be required. Yes, so you need more current assets if your operating cycle is too long. Exactly. So in determining the liquidity required by the company, net operating cycle is more appropriate. That's the net working capital management, because the longer the net operating cycle, the more the liquidity the company will require. So net working capital or net operating capital is determined by removing the number of days the company enjoys on accounts payable from the operating cycle calculated above. This method is used in calculating the number of days of receivables used and calculating the payables by substituting receivables for payables as follows. So we have payables. Then, okay, so we have inventory, like we've seen, we have receivables, and we have payables, and calculated that cycle. So what does the ratio mean for net working capital to sales ratio? It indicates the percentage of the company's sales that is supposed to be used as working capital. So part of your revenue is what you take out to use as working capital to generate more revenue. That's what it means. So the higher ratio suggests that the company is using more of its resources to finance day-to-day operations, while a lower ratio indicates that the company is generating sales with less reliance on working capital. So let me drive back, having looked at this small introduction. So let's look at using the same Dan Kabir, current assets minus current liabilities, and let's calculate our net working capital. Okay, so let me pick these headers here. Okay, so from Dan Kabir, let's look at the net SFP, and let's pick our total current assets. Let's pick for the 3 years. So this is for 2020, 2021, and 2022. Exactly. So we have our current assets based on the formula. And let's go for our total current liabilities. So our total current liabilities is 420, 461, and 530. Exactly. So from the formula, we have it stated here as current asset minus current liability. So that is our net working capital. So what is our net working capital from the calculation? We now have net working capital. So we have the current asset minus current liabilities. This minus this, not divided by. All right, let me just drag this. We have this. So we have our working capital now, and it's favorable. Favorable means it's positive. So our current asset is more than our current liabilities for the 3 years. This is good. So now let's see our sales or our revenue. Our sales or our revenue. So we are not using whether credit or cash. We're just going to take the revenue or the sales. Okay, exactly. So we have our sales. So now our net working capital to sales ratio. So we have it as 625 divided by our revenue. So the ratio is 0.51 is to 1.00. What does it mean? Half of your working capital is what you use from your revenue, or half of your capital is what is used to run your sales. You can see that your working capital is half, that is 0.51 of your revenue. So let me do that of, okay. So we have 0.52 is to 1.00. So we have almost the same thing have for 2021 and 2022. So I think half of the money generated for revenue each year is used as working capital. Well, it will depend on our interpretation anyway. So because we have 51%, 52%, 52% of revenue. But since it's a ratio, we have to say how many it is to its number. Okay, so from that result, let's look at its implication. Now, the implication is that a balanced net working capital to sales ratio reflects effective use of working capital in driving sales. So balance is what we are talking about. So what amount of your net working capital to your sales is a balanced one? It will now depend on your interpretation and the industry where you are domiciled. So balance will depend on your operations, your interpretation, and how you are able to drive operations is the balance. So there is no hard and fast rule that, okay, this percentage or this amount or this ratio is the ideal amount or benchmark. So the balance will now depend on your industry and how you're able to facilitate your operations to your working capital and in driving sales. A ratio that is too high may indicate inefficiency, where too much capital is tied up in operations. So looking at, let's go back here now and talk small. So if half of your working capital is used to generate revenue, so if you have something like 80%, I think it's too high. Even 51%, in our opinion, is high, but then it depends on the industry.
Yes,
if you have less,
51% is high.
Yes, in my own interpretation, I don't know what is the working capital requirement of the pharmaceutical industry, but I think 51% is high. Your working capital should not be more than, generally, in my opinion, it should not be more than maybe 30%. I don't know. I think 30% makes a lot of sense. Yes, 30% of working capital, so that you can have money to do other things. You have long-term investments. You have short-term investments and other things to do to drive growth, expansion. So 50% should not just be for working capital. I think it's high in my view. So looking at our conversation, the ratio that is too high may indicate inefficiency, where too much capital is tied up in operations. Exactly. While a very low ratio may suggest that the company is undercapitalized and could struggle to sustain its sales activities, which is true. So you need to fuel the car. You need salespeople to go out to get more customers. You need salespeople to do advertisement, publicity, and all these things are paid from working capital. And without sufficient working capital, you may not be able to drive these activities, and you may not be able to push your products and services out there. So it's very important that the working capital should not go too low. It's very essential. Here we fuel every time. We fuel the car, the pool car, where you go out for sales and business development activities. So if there's no money, they will not go out. They will just sit down in the office and be watching you. They'll be watching Facebook on the system. So you need to. So salespeople, they will not go out. So you need to enhance and help them to go out, and the activity should culminate in conversion of clients. So the rate of conversion of potential clients to actual sales is very important, and working capital helps to drive that. Okay, so what are the cause and effect of a high net working capital? Causes are excessive inventory. So it still comes down to your operating cycle. You have too much inventory, slow receivables, and even efficient use of longer time to pay payables shows inefficient use of working capital, and that's what causes a high net working capital to sales ratio. And the effects includes reduced cash flow, increased operational costs, potential liquidity challenges, exactly, if too much capital is tied up in working capital. While a low one is generally advised, the causes include effective working capital management, quick inventory turnover, fast receivables, and fast also payables. And the effects include improved inventory or improved liquidity, better cash flow, but it may indicate potential risk if it becomes too low. So like we said, balance. And most chartered accountants, this is where we're coming. We need to balance this ratio to ensure that there is no halting of our short-term obligations. So in conclusion, the ratio is a useful indicator of how well a company manages its working capital in relation to generating revenue. Maintaining an optimal ratio is key for liquidity and also to drive effective operations, sustain growth, and ensure that the company can fund its activities without over-reliance on external financing. So when you start borrowing, like overdraft, taking money from the bank, and you pay interest, external financing can be a burden on your financial operations. So avoid it and make sure there's balance. Make sure this ratio is optimal and you're maintaining your working capital effectively. All right, so that will be the end of liquidity ratios. Do we have any question? We've looked at one, current. We've looked at quick asset, cash, absolute liquid, inventory holding, receivables collection, trade payables, cash operating, and net working capital sales. So do we have any questions? We looked at 9. Wow.
How do we grab all this? How do we cram all this? How do we cram all
practice.
this?
No, the examiner, he will test all this. How would the examiner test all this? He's not wicked.
But there's possibility you can just pick anyone.
The possibility.
Yeah, so you will not cram, it's practice. Once you practice it, you get familiar with it. So it's practice. You have done Kabir now, so you can go back one weekend, just practice with it and familiarize yourself with it. And you see under exam condition, you remember in the future any of them. So just practice. Don't after this class leave it. Please look at it once or twice, and you should be able to understand it and not cram. Don't cram, please. Don't cram it. Okay, so any question on those so that we can go on a short 10 minutes break